If you buy a few $100s worth of Bitcoin, you won't become a millionaire overnight. But if Bitcoin works out the way I think it will, owning even a small amount can have a major impact on your life over the long term. Eventually, I do think Bitcoin will be used as the world reserve asset and everyone will use it to save, but we're a long way from that. At this point, Bitcoin will just be used as money. It'll be used as a savings tool and not an investing tool, because one Bitcoin is equivalent to one Bitcoin, just like how 1 ounce of gold is equivalent to 1 ounce of gold, and both of them will maintain their purchasing power over time. But when you just hold Bitcoin, just like gold, you don't get yield. It doesn't produce anything, but that's not necessary. The reason why Bitcoin is so special is because it eliminates a lot of the risks that you take when you invest in something. In my opinion, Bitcoin's price is going to go up until everyone in the world owns some and everybody can benefit from it. In this video, I'm going to explain to you exactly why. I don't think we're close to the point where everybody owns it yet and where the price stops going up. Eventually, once we see the price go up to a certain level, it will stop going up. But you can't call something the world reserve asset when most people don't own it, when most people don't know what it is, and most people really don't care about what it is. Bitcoin is specifically designed to be money, but it'll take time to become adopted. It'll become easier to use over time as technology improves. And right now, that's not the case at all. It's pretty difficult to wrap your head around what Bitcoin is. Investing in Bitcoin and understanding it requires a pretty long time, but I think in the future it'll become easier as education gets better. But by then, the price will be much higher than it is today because a lot more people will own it. I think if you figure it out early enough, though, buying a small fraction, it's a small amount, will have a major impact on your life. But most people don't see it yet because this reality is so far out from today. Right now, we're really early, and Bitcoin's price needs to go up significantly for it to be taken seriously, like gold or real estate or stocks. But the way that markets work, whether it takes a year, 20 years, 50 years, Bitcoin can't be stopped. I just don't know how long it'll take. For all we know, we could see $100 million Bitcoin by 2033 if every government in the world, every central bank, every individual is forced to buy it. Eventually they will be, because that'll be the only thing that merchants will accept for their goods and services. And we could also see the prices move sideways until 2033. Prices goes consistently between 60 and 70,000, drops, goes back up, drops, goes back up, and we all end up disappointed. But if you want to compare Bitcoin in US dollars to another currency, so for example, the Nigerian Naira, the Naira went from 64,000 Naira per Bitcoin in 2015, and now, 9 years later, it's worth 100 million Naira per Bitcoin. So 1 Naira is the equivalent of 1 fraction, which is Satoshi. 1 Naira is equivalent to 1 Satoshi, less than 1 Satoshi, because the value of the Naira has dropped so significantly. Most people will say that, oh, I didn't expect this to happen. This can never happen to the dollar. It can't happen to anything. But who would have expected to happen to the Nigerian Naira? I've spoken to people in Nigeria. I've spoken to people who are using it as a savings tool, and they didn't expect it either. The main reason why Bitcoin's prices keeps going up is because the Naira has no limit for the amount that can be produced. There's no limit. There's absolutely no limit for how many Naira can be produced, how many Naira the Nigerian government, the Nigerian central bank can produce. And this is exactly the same as the dollar. Most people are ignoring Bitcoin because they think that $100 million, $10 million, $1 million is not possible. They think we saw $60,000, $70,000 after 15 years, and over the next 15 years, we're going to see $140,000. But the issue is, Bitcoin's price won't move up this way. It'll move up exponentially. It'll move up by orders of magnitude. Today, because the dollar doesn't work as a store of value, other assets are being used as a store of value because the currencies that we use are just constantly being devalued. They're constantly being debased. Bitcoin directly competes with the US dollar as a medium of exchange and with stocks, real estate, and gold as a store of value. But Bitcoin is so much better than all of these other assets because all of these other assets don't really have a limit, and there's an uncertain supply. There's no known supply for all of these assets. So for example, for gold, we have no clue how much gold exists. We have no idea how much is around the world. We've been mining gold for 5,000, 6,000 years. nobody has kept an account of all of the gold that's been produced. On the other hand, with Bitcoin, we know exactly how much Bitcoin has ever been produced. We know that there are something like 19.7 million coins, and the maximum supply will be 21 million. Same thing with houses. Supply of houses is technically infinite. There are 144 million houses in the US, something like 2.4 billion houses in the entire world, but more can be created. We have better technologies that will help us build houses faster, modular homes, stackable homes. There's all kinds of 3D homes coming out. Materials are getting better. We'll be able to build higher. With stocks can be issued if the company needs money. Stocks, there's no real limit to how many can be created. Of course, the company won't print more to not ruin their reputation, but they can, right? There's nothing stopping them from doing so. On the other hand, with something like Bitcoin, nobody can change the supply. We know that there will only ever be 21 million. Changing the supply would be extremely difficult. Producing more Bitcoin is extremely difficult. And one Bitcoin, if you were to own one Bitcoin, you'll always own one out of that 21 million total supply. There is a halving every 4 years, every 3 years and 10 months or so, where the supply, the newly issued supply, decreases by 50% each. Every block, every period of time where Bitcoin is produced. So every 4 years, the supply is decreasing by 50%. And this is enforced by thousands of computers around the world. You may think, what if miners, the people who are actually producing these Bitcoin, what if they say, no, we want more Bitcoin, we want to continue to produce it? But it's not up to them, right? It's up to the people who run the computers, who run the software that Bitcoin runs on. If they notice that somebody's trying to manipulate the network, they're not going to accept the blocks that computer is producing. So there's no way to increase the supply past that 21 million. I know a lot of people say that it is, but it isn't. For the supply to increase, all of the computers around the world, all the computers running the Bitcoin software will have to agree to the change. And that basically means that they're diluting their own ownership in Bitcoin. Changing the supply is extremely difficult. Producing more Bitcoin is also extremely difficult. It takes businesses years to actually build up to the point where they can become profitable miners of Bitcoin. And again, there's a massive investment. There's competition. The entire world wants to own this asset. And with every other asset, there is no way to make it more difficult to produce more over time. Everything becomes easier to produce because of technology. On the other hand, with Bitcoin, there is something called the difficulty adjustment. It makes it more difficult to produce more Bitcoin as more computers enter the network, as technology gets better. Bitcoin is also the only asset that you can take self-custody of. It can't be erased from existence. It can't be taken out of your it can be taken without your permission. It can't be frozen, right? On the other hand, again, US dollar, the US government locked away Russia's money. They devalue everybody's money whenever the US government borrows or prints more money. Everybody's savings are devalued. So why would you choose to hold something like the dollar when compared to something like Bitcoin, you know for a fact how much wealth you'll have? So based on all these reasons, I think the price of Bitcoin will continue to go up over time. There's also the supply and demand factors. Supply is definitely not keeping up with demand. More people want Bitcoin, but enough people aren't selling what they have at the current prices. So the buyers have to offer more and more money to buy what's on the market. And more Bitcoin is being purchased by people who will probably never sell. Some people who will sell at much higher prices. People are buying, they're never selling, or they plan to sell at, let's say, $1 million, $10 million, $15 million. A lot of people aren't going to sell for years, for decades. You can also do something called a time lock with Bitcoin, which is where you lock it away for a certain number of blocks, and you can't touch that Bitcoin. No matter what you do, you can't touch that Bitcoin again. There's going to be some Bitcoin that aren't going to be available no matter what for a certain period of time, and this is what time locks does. Having a time lock makes it so that you can't touch that Bitcoin regardless of what you do. So what this means is that you can't print Bitcoin, you can't create more Bitcoin even if you tried, and you can't force coins back to the market even if you killed the person who owned them, because they may have locked their coins away for years or even decades. You need to have peaceful negotiations with the people who own Bitcoin to get what they have. But again, let's go even further. Out of the 21 million coins that are going to ever be available, there aren't going to be 21 million in total because quite a few of them have been lost. It's estimated that 3 to 5 million are gone forever because the owners passed away, they lost their keys, or they sent their Bitcoin to the wrong address. Every Bitcoin that exists is held by someone, so you need to convince them to sell what they have, unless they have no access to it. Of course, you need to convince them if they have some, you need to convince them to sell it to you at whatever price they want. So, for example, some people won't sell their Bitcoin until the value of Bitcoin goes up enough for them to buy a house, for them to buy certain things, to go to certain levels of their life. Let's say they want to pay off their mortgage. They won't sell any Bitcoin at all until they can pay off their mortgage with a fraction of it. So there's unlimited demand for Bitcoin. Population keeps growing. More and more people are being added to the pool of people who can benefit from Bitcoin. The number of people on the earth are constantly increasing. I think it's something like 250,000 people per year that's increasing by. Right now, we're at about block 847,000 or so. 93.8% of the total supply has been issued. There's something like 1.3 million Bitcoin that are left to be mined. So in total, 19.7 million, 19,700,000 Bitcoin have been created, and they're held by people. So what this means is 94% of the Bitcoin supply is issued. It's already been issued. It's already owned by someone, and the remaining 6% of the supply will take 116 years to be issued. This is all pre-programmed. We already know when all this Bitcoin is going to be issued. So the very last coins are going to be issued in 2140 after there's 34 halvings. On the other hand, like I said before, real estate and stock supply just keeps going up. There's no way to stop people from building houses. If there's a profit to be made, they can build more houses, right? There's no way to stop governments from issuing more bonds. As long as there's a buyer, there's now artificial buyers. There's now the Federal Reserve buying the U.S. government's bonds. As long as there's a buyer for the U.S. government to purchase its bonds, it can continue to go into debt. And people are just pretty much buying stocks at this point with their savings because they know they have to buy something to avoid being poor. And if they don't, they're going to end up having their money taken from them by inflation, by the value of their money just disappearing overnight. Same thing with real estate. There's a lot more work that has to be done to manage properties, to own properties, but the reward is so much less compared to what Bitcoin gives you. Now, Bitcoin is taking over that use case. It's outperforming stocks massively. It's a much better store of value because you don't have to do anything. You don't have to worry about an executive team making the wrong decisions. What we're going to see is that the price will keep going up because more and more people will want Bitcoin, and most people have zero allocation, or the people who already own some will continue to want even more. There is something that you can actually look at something to see that the demand keeps going up, which is the price, the market price. That's the equilibrium price, where buyers and sellers are agreeing that buyers want to buy at a certain level, sellers are willing to sell at a certain level. Whenever there's an agreement between buyers and sellers, they do make a trade. And over time, we're going to see the price go higher and higher because fewer and fewer people are willing to sell at these lower prices. For somebody like, let's say right now, a lot of very wealthy people are still ignoring it. Like, let's say Warren Buffett, for example. If he wanted to buy $100 billion worth of Bitcoin, his company, Berkshire Hathaway, they have something like $150 billion just set aside in cash. So if they wanted to buy $100 billion worth of Bitcoin, you would think that right now Bitcoin's market cap is something like $1.4 trillion. You may think that, okay, if he buys $100 billion worth, he'll be able to get 10% of the total, almost 10% of the total supply, 8 to 10% of the total supply. But the thing is that there isn't $100 billion worth of Bitcoin for sale. What's going to happen is, as he buys some over time, the number of people that are willing to sell at the current price decreases and the price goes up. As more and more of the Bitcoin is cleared from exchanges, and as he buys more and more of it, the price will continue to go up. So how markets work is there may be a certain amount of Bitcoin available at a certain price. The person who wants to buy it has to go, they have to buy more, but they have to buy at a higher price. So let's say $10 million available at 70,000, $20 million at 71,000, $25 million at 72,000. The price will have to keep going up until all of his purchases are fulfilled. All of his demand is fulfilled. What we're seeing, though, is that people are buying over time. They're buying in small batches. There's apparently it's an exchange, but there's some group, some person who's buying 100 Bitcoin every few hours, and they're buying something like 1,000 Bitcoin every single day. ETFs are buying something like 500 to 1,000 Bitcoin every single day. We're seeing Michael Saylor's company buying a few $1 million worth every single month. Keep in mind that, like I said, there's only 21 million Bitcoin, and there's 60 million millionaires on the planet and 2,400 billionaires. Most of these people haven't even started paying attention yet because Bitcoin's price isn't high enough for them to care yet. And so many people own thousands of coins, meaning that the supply of 21 million is not going to be equally distributed. For example, Michael Saylor owns 17,000 Bitcoin. The creator of the network, Satoshi Nakamoto, owns 1 million Bitcoin. And who knows? Maybe these people may redistribute what they have over the future, but I don't think so. Maybe they will, maybe they won't. I don't think they will. But if they do, of course, people are going to be able to buy a little bit more. But again, the amount available for everybody to buy is still less than 21 million because of the lost coins, because of the coins that are locked up, because of the coins that will never come back to the market. I would say that the amount of Bitcoin available to be bought right now is probably less than 3 to 5 million coins. A lot of people are willing to sell at higher prices. Those coins will go back on exchanges. Right now, I think on exchanges, there's like 1.72 million coins available to be bought. Don't quote me on that, of course. But over time, we're going to see more and more of those coins being drained off the exchanges. The fewer coins are going to be available. And a lot of those coins aren't even available to be bought. A lot of people are just using the exchanges as almost their own wallet. So after all of that, how much Bitcoin do I think you should own? You don't have to buy whole Bitcoin. So a lot of people have this unit bias where they think they can only buy one Bitcoin for $70,000, however much the price is at the time of this video. Right now, it's about $70,000. I don't know when you watch this video, maybe 80,000, maybe 60,000, maybe 40,000, maybe 100,000. But one Bitcoin can be split into 100 million Satoshis. So Satoshis are the very smallest unit of Bitcoin. So it's 0.000000001 Bitcoin. So that's 8 zeros and a 1. One Bitcoin is worth 100 million Satoshis, means that you can buy fractions of Bitcoin for less than a penny. If you want to buy $1 US dollar worth of Bitcoin today, you'd get something like 1,400 Satoshis. And if we do the math, how many people can own Bitcoin? So if you have people who own 10 Bitcoin, only 2.1 million people can own that much, which is 0.026% of the world. You can have 21 million whole coiners, which is 0.26% of the world. You can have 210 million people who own 0.1 Bitcoin. That's a million Satoshis. Yeah, that's 2.6% of the world. You can have 2.1 billion people who own 1 million Satoshis each, which is 26% of the world. But keep in mind, again, there are a lot of people who own way more than 1 Bitcoin. There's a lot of people who own more than 0.01. A lot of people own more than 10. So each person who owns 1 Bitcoin eliminates 100 people from owning 1% of a Bitcoin. So one person buys 1 coin. That means that 100 people can't buy 1% of a coin. A lot of people own hundreds or even thousands of Bitcoin. A lot of these people will never sell. Michael Saylor alone owns something like 17,000 Bitcoin, meaning that 1.7 million people can't own 1% of a Bitcoin, 0.01 Bitcoin, because of his holding. And if we split the total amount, the total 21 million between everybody in the world, 8 billion people in the world, the total amount that anybody would be able to get is around 262,000 Satoshis. So 262,000 Satoshis, that's if everything was split equally through, equally with everybody in the world. But that's not going to happen, of course, because like I said, I've said this multiple times, some people have way more than 1 Bitcoin, 10 Bitcoin, 100 Bitcoin, 1,000 Bitcoin, while other people have none. So let's say we have the number I mentioned before, 5 million coins. Let's say 5 million coins are available the next 10 years. Bitcoin goes to $100 million. Right now, we have at most maybe 5% adoption. Maybe by 2044, we have 80, 90% adoption. If we have 80% adoption, that means that 6 billion more people at the current population, 6 billion more people will want to buy Bitcoin. And if those 6 billion people split this Bitcoin equally amongst themselves, I would guarantee that most people won't have even up to 10,000 Satoshis. It won't be split equally. The people who start buying now, of course, are going to have more than the people who buy in 2044. Each person will be able to get 0.00833 Bitcoin or 83,333 Satoshis. This, if Bitcoin goes to $100 million, this will be worth $83,000 or so. I don't know what after inflation, what the value will be. And most people won't accumulate this by buying. They're going to be paying for it. They're not going to be paying for it. They're going to work for it. They're going to accumulate it with their hours of work. Today, you can buy 83,300 Satoshis for about $60 US. You can also buy 1 million Satoshis for $710. And that million Satoshis, if we really look at the numbers, I don't think there will be more than 100 million people on Earth who will have 1 million Satoshis. Today, that costs you $710. If Bitcoin does go to the numbers that I think it will, eventually it'll hit $100 million. That's where I think it's going. That 1 million Satoshis will be worth $1 million. And today you can accumulate that same amount of Bitcoin for about $70 or so. You can accumulate it over time. You don't need to buy it all at once, right? You can buy it over time. You can set up recurring buys. That's the minimum that I would recommend as a goal. Right now, a minimum of 1 million Satoshis. If you can get to that point, if you can get to 0.01 Bitcoin, I think you'll do really, really well. Keep in mind, this has to be money that you don't need for a long time. You can buy with recurring buys. You can buy with, let's say, $1, $5, $10 every week, every month, however often you can buy. Put a little bit of money into it. These million Satoshis will be worth $1 million at some point in the future, right? There's no way to stop that from happening. There's no way to stop market participants from buying Bitcoin. I don't know when. These are just guesses. Of course, there's no real guarantee. But if you owned a small amount, who knows? Maybe it'll help you buy a business. It can help you pay off your mortgage. You can give your family an inheritance if something happens to you. And it only costs you a few $100s today, right? The price will just go up from today. From here, most people, like I said, have no allocation. You can build a stack for a very small amount. You can help your family and friends. You can teach them how it works. And most people probably won't want to own some. What you can do is, if you feel generous, you can accumulate some for your family and your friends, not just for yourself. That's one of the good things about being so early, right? Buy whatever you can, even if it's $1 per month. My personal first buy was for only $10. I got a very small fraction of Bitcoin. It was in 2022. I spent $10. I got something like 16,000 Satoshis or something like that. But over time, you can accumulate. You can buy. You don't need to buy it all at once. Make sure you look into self-custody. You can look into something called collaborative custody if you have a significant amount of Bitcoin. If you want to hold Bitcoin for a long time, you need to make sure that your custody is your self-custody, however you hold your Bitcoin, is down packed. You have to make sure that you have that understanding of how Bitcoin self-custody, how Bitcoin custody works. Make sure you have a minimum 5-year time horizon, because anything can happen in the short term. Make sure this isn't your rent money. Buy Bitcoin with a certain percentage of your portfolio. I did some calculations. If you were to buy Bitcoin with 1% of your total assets, and Bitcoin's price doesn't even go up even close to the numbers that I think, you'll have about 60-70% of your portfolio in Bitcoin within the next 20-30 years. And I mean, what's the problem with that, right? What you're doing is you still have your old assets, but you're also protecting your downside by buying something that has an unlimited upside. I think this is something that most people should look into. I think this is something that, because of how the current financial system works, the current financial system, in my opinion, will eventually fall apart. I don't know how long it'll take. It's specifically designed to be a Ponzi scheme, and Bitcoin is the best shield against whoever wants to hurt you with that Ponzi scheme that we're in right now. If you were to look into this, try to learn how Bitcoin works, try to learn how financial systems work, try to learn how fractional reserve banking works. All of this stuff is solved by Bitcoin, right? And if you were to own even a small amount, I personally think Bitcoin will hit ridiculous numbers, but most people are not going to, they're going to ignore it. Like the title of this video is, most people are going to ignore Bitcoin until it hits $1 million or more. And I don't want you to be in that situation. If you're watching this video, make sure you secure some amount for yourself, for your family. Tell your family and friends about what this is. Share this video with your family and friends. Leave a thumbs up so more people see this video. I think this is going to be a very valuable experiment. The people who are actually learning about this right now are not going to regret it. I think the people who are ignoring it are definitely going to regret it. Make sure you're not part of the people who ignore it. Make sure you're part of the people who put in the time to learn what this is, to figure out where this is going and how this could impact us in the future. A couple of months ago, I created a video called "Most People Will Ignore Bitcoin Until It Reaches $1 million or More." In that video, I talked about why Bitcoin is going to reach $1 million or more. And in this video, which is part 2, I want to talk more about why most people aren't going to see what's coming. Let's get started. I think most people are going to ignore Bitcoin and they're going to completely miss it because they're benefiting so much from the current financial system. For example, we have real estate investors who buy a property, they purchase it, they hold on to it forever, and they're pretty much guaranteed to keep making money for a very long time because they know for a fact that the money that this property is being valued in is going to continue to be devalued forever, meaning that the price of the house that they own will continue to go up forever. This is a massive problem for the average person because the average person can't afford a home. But anyone who already owns these houses is at a massive advantage. There are people who own tens, hundreds, or even thousands of properties, and they argue against why Bitcoin isn't a great asset. One of the problems with this is, of course, that they're biased. They've been taught in the past maybe that real estate is the best asset ever. Real estate is the only asset that they need. Land is scarce, so buy some. They've been taught all these things, but in reality, a lot of this is not true. Real estate is more abundant than people think. There's a lot of land available that we haven't even discovered yet. And if we really wanted to, we can keep building houses higher and higher and higher. What this is going to do is it's going to devalue their properties, and it's going to make it so that demand for properties is fulfilled with new supply that enters the economy. There are also companies that are building homes in factories, and they're delivering these homes to people who own a piece of land and just want to build their property. So most real estate investors don't see where Bitcoin is going because they want this easy money. They want this passive income. They're okay with hoarding as many houses as they can get, and they're fine with having to rent these houses out to other people. Even if the rent has to go up so much that the majority of people can't afford their house, they don't care because to them, it's passive income. Like I said, there's people who own thousands of properties. They don't even have to do anything. They have property managers handling all of these properties for them. All they do is sit at home, collect rent, and then they can increase the rent whenever they want to. They have power, and that's exactly what they're looking for. Nobody needs the cash flow that comes from 1,000 properties. They're doing this because they know for a fact that people will need houses and they own something that people need. That's the goal here. So I think because of this passive stream of income that's consistently coming in, because they've been treated so well by the legacy financial system, they can't see a competitor coming in and eating their lunch. The same thing applies to the stock market where people are getting dividends while the company that they have partial ownership in is exploiting its workers and paying them way less than the profits that it's making from their labor. Now, I'm not saying that there should be a minimum wage or that wages need to go up. What I'm saying is that these companies probably shouldn't even survive. If they didn't have so much power over the supply and demand for labor, then this wouldn't be happening. The world wouldn't be in the mess that it is right now. For example, Walmart and McDonald's investors are some of the most profitable investors in the world. Where do these profits come from? They're being subsidized by taxpayers. They're being subsidized by anyone who holds US dollars. SNAP benefits are food stamps. So the employees of Walmart and McDonald's are having their labor subsidized, even though these are multinational companies. These companies are basically just concentrating all of the wealth with their owners and their executives. So again, if somebody is benefiting from this system and they own Walmart or McDonald's shares and they're getting a consistent dividend and they don't even have to work, why would they advocate for something that directly competes with this system? Same thing applies to bank shareholders like Warren Buffett. Warren Buffett is never going to see where Bitcoin is going because he benefits so much from the old financial system. Bitcoin directly competes with banking, and Warren Buffett is a massive investor in banks. He loves how banks operate because they can charge interest by lending people money. He loves the passive income that comes in. He loves that consistent cash flow. With Bitcoin, that's not possible because with Bitcoin, if you want yield, you're going to have to take some risk. Warren Buffett likes the idea that you can just own a bank stock. The banks can just print more money. Central banks will print more money. Eventually, governments will bail out those banks. Those banks can make tons of profits. They can share those profits with the owners, but any losses are distributed amongst anybody who saves in dollars. In the coming years, we're going to see a lot more bailouts of banks that made stupid decisions like buying investments that they shouldn't have. So all these people who own thousands of rental properties, who own thousands of shares of these companies that are exploiting their workers, they're not going to want to advocate for Bitcoin because it takes time to study Bitcoin, and they don't want to put their time towards learning about this thing. They're putting their time towards things that grow the financial system even more. They're borrowing even more money. They're borrowing money to pump up the price of real estate, and they're benefiting from it. So why would they go to this new system that doesn't allow them to make free income? Their goal is to spend money and get cash flow while still owning the assets that back that cash flow. They don't want to give away that cash flow to anyone. They want to hold on to it as long as possible. Bitcoin takes that power away from them. Even though Bitcoin is going to grow a lot more, they don't care about capital gains. What they care about is cash flow. They care about being able to hold their assets forever. That's why real estate works so well for them. Banks will keep lending them more and more money against the house that they own, and they can hold that house, continue to receive cash flows, continue to receive rental income, and they don't have to worry about anything because they'll never have to sell that house. On the other hand, when you advocate for Bitcoin, you're advocating for a brand new form of money that banks can no longer print and you can't borrow against. On a Bitcoin standard where the world is using Bitcoin as money, real estate is going to be a depreciating asset that loses value every single year. Most companies are going to go bankrupt because they're not going to be able to generate more Bitcoin every single year or even keep up with how much Bitcoin they generated the previous year. Today, a lot of companies rely on debt and they rely on venture capitalists who fund their operations, and they can keep operating for a longer and longer time even though they're not profitable. For example, companies like Uber, who make absolutely no money, they have this massive network of VCs who want to continue to fund them. They also borrow tons of money. They buy shares of other companies, they sell them. They're basically not making money from their operations. What they're making money from is financialized products. There are a lot of companies like this out there, and a lot of these companies are going to go bankrupt because they can't make money on a Bitcoin standard. With fiat currencies, people can just borrow more and more and more, and they can spend all of this money on whatever they want to. With Bitcoin, you can't borrow unlimited funds. If you're borrowing to invest in a company, for example, and your company doesn't do well, your investment is going to zero, and you're going to have to pay back your lender. If you can't pay back your lender, there's nothing the lender can do to get back the money that you borrowed from them. The only thing they can do is take the loss, and move on with their business. Some lenders today are making really irresponsible decisions by lending to people who will never be able to pay them back. On a Bitcoin standard, this would never happen because banks aren't going to lend Bitcoin for consumption. They're very likely only going to lend it for starting a business. My assumption here is that the world is going to eventually move away from fiat currencies. Fiat currencies don't work as money because we have to use stocks and real estate to invest for the future because these fiat currencies can't store value. So back to most people ignoring Bitcoin until it reaches $1 million or more. All of these investors are going to ignore Bitcoin because they still think it's a joke. The asset that they own has a massive market cap that Bitcoin isn't even close to yet. They're ignoring it because they don't realize that Bitcoin is going to replace their asset. It's not competing with their asset. It's going to entirely replace it. Bitcoin competes as a store of value with every single asset in existence, including real estate, stocks, and bonds. These are the biggest asset classes in the world, and the people owning these assets, I think, are going to be disappointed. They may not see the nominal value of their assets decreasing because the US government is going to keep borrowing money, the Federal Reserve is going to keep printing money and adding it to the economy, but they're going to see the real value of their assets decreasing in terms of Bitcoin. A house that costs something like 6 to 7 Bitcoin today will probably cost less than 1 Bitcoin within 20 years. We're going to see this trend and nobody can stop it because over time, more and more houses can be built. The supply of land is essentially unlimited where you can build higher and higher. So more and more houses are going to be built to fulfill the demand for shelter, while at the same time, more and more Bitcoin can't be created. There's a finite supply of Bitcoin and the demand is infinite. So even if they see where Bitcoin is going at $1 million, they're still going to be early, but most people won't see it by then. They're going to see it at 5 million, 10 million, $15 million. It takes a really long time to actually study Bitcoin and understand where this is going. So even if it hits $1 million, it's not like these people are going to just automatically think this is going to billions of dollars. In order for people to convert their other assets into Bitcoin, they actually need to understand what it is. And most people will not put in this work until it's too late. So like I said, most people are going to ignore Bitcoin until it reaches $1 million or more. Most people are not going to have any allocation whatsoever. The people who understand Bitcoin are accumulating more and more and more. And they're probably not going to add this Bitcoin back to the economy for another few years or even decades or ever. So if you're a real estate investor or a stock investor, your time is running out. You can get a significant amount of Bitcoin for your houses, for your stocks today, but eventually the amount of Bitcoin that you get is going to decrease by 99.9%. In my opinion, this is inevitable. Of course, there could be a black swan event that kills the Bitcoin network. I don't think that's even possible at this point, but I don't know what I don't know. But if things go the way that I think they will, housing is going to drop significantly. The bond market is going to lose a large chunk of its value, if not all of it. The stock market is also going to see a massive loss because a lot of the funds going into the stock market are passive flows where people are just buying blindly. They have no idea what they're buying. Once these people realize that Bitcoin is a much better asset, they're going to divert those flows into Bitcoin. This is where I think the world is going. I think people are going to keep ignoring Bitcoin until it reaches much, much higher levels from here. If you're putting in the time to understand how Bitcoin works right now, you are so early. Make sure you watch the video on your screen if you want to know how early you really are. If you found value in this content, make sure you leave a thumbs up and maybe even a comment down below with your thoughts. Most people are going to ignore Bitcoin until it reaches $1 million or more. This is part 3 of a series that I've been putting together. In the first part, I explained why Bitcoin will go to $1 million. In the second part, I explained why the wealthy are ignoring Bitcoin today. And in this third part, I'm going to explain why financial professionals are going to ignore Bitcoin for a very long time until it reaches much higher levels than it is today. I want you to watch this video with an open mind and watch till the end so I can properly get my point across. If you stop halfway through, I don't think you'll completely get it. Let's get started. I strongly believe that Bitcoin is a test of open-mindedness. Most people believe that Bitcoin is worthless because they believe that assets should perform and be a certain way. But Bitcoin is completely different. It challenges every single one of their beliefs. They're using the wrong metrics to evaluate Bitcoin because they're used to using these metrics in the old financial system. For example, they evaluate real estate and stocks based on their ability to generate cash flow. The smartest people in the world don't understand how this thing works, even though they're some of the best at math. They understand all these functions, they understand all these formulas, but they don't understand how Bitcoin works because they can't wrap their head around the fundamentals. Like I said, in the current financial system, assets are evaluated based on their ability to generate ongoing cash flows. And I want to show you some of these metrics that are being used and why they don't apply to Bitcoin. I'm going to switch over to a spreadsheet, so if you need to lower your brightness, do it now. I created a spreadsheet with all these formulas. I'm going to go through each one. And there are some for stocks, there are some for real estate, and of course, Bitcoin doesn't really have the same formula type of evaluations, but I'll go through how to evaluate money and Bitcoin as well. So the first thing that you can do for stocks is you can figure out the discounted cash flow, which is the net present value of free cash. Maybe you get profits, maybe you get revenues, whatever you want to use for this. This is the amount that's available from the business to be distributed to shareholders. So what you're doing is you're predicting what kind of cash flows the company is going to generate over the next 10, 20, 30 years. Then you're predicting what the interest rate will be over the next 10, 20, or 30 years based on the returns that you want. Keep in mind that you could be wrong on both of these. You could be completely off on the cash flows or the interest rates. So this one is pretty much just subjective. Everybody's going to come up with a different number. The second one is comparing metrics. So for example, you can compare price to earnings ratios for multiple companies in the same industry. This is the market price divided by the earnings per share. The higher it is, the worse off it is. It means that this company may be overvalued if it's higher. If it's lower, it may be undervalued compared to its peers. It could also be that the company maybe is the most technologically advanced. Maybe they're making the best decisions. Or if it's lower, maybe they're making worse decisions. Maybe they have something coming up and the market has figured it out early. The next one is enterprise value to EBITDA. This is essentially just enterprise value, which is the market capitalization plus the market value of debt minus cash and equivalents divided by earnings before interest, taxes, depreciation, and amortization. So as we go on, we're going to see a lot of these are formulas that you need to have a base understanding of each of these individual components. And if you don't understand the individual components, you really can't use these metrics. The next one is asset-based evaluations, where you're evaluating an asset based on its own merits. So for example, in this case, we have book value, which is the net value of the business, assets minus liabilities. And then we have liquidation value, the estimated value that you would get if you sold the business's assets. So this is a graphic showing you how you would calculate that. The next one is earnings multipliers, price to sales, which is just market value per share divided by the revenue per share. Pretty simple. The next one is price to book ratio, market price per share divided by book value per share. The formulas here may be easy, but it's all the components that you need to know to input all the right numbers. And if you don't know those components, then you can't input the right numbers. You can't get the right valuation. The next one is revenue and profits. Gross margin is gross profit divided by revenue. The next one is dividend yield. Dividends are the company giving part of its profits to its shareholders or its owners. The dividend yield is the annual dividend per share divided by the price per share. Then we have real estate formulas. Real estate formulas get even more complicated here. We have the income approach, which is capitalization rate, net operating income, NOI, divided by the property's current market value. This is called the cap rate. The next one is gross rent multiplier, property price divided by gross rental income. The next one is sales comparison approaches. So what you do is you basically compare one property to the other ones that were sold in the same area based on certain metrics, based on certain characteristics. So for example, we see here price sold, date of sale. I'll zoom in a little bit. Condition, square feet, bedrooms, bathrooms, and then you make an adjustment based on how one property is better than the other. So again, this is subjective. I think that this is purely subjective because when you have people, I used to work as a real estate agent. When you have people looking at different properties, everybody has a different gauge of what this value should be, or gauge of what one bedroom should be. So for example, we see here, one bedroom here is worth $4,000 in this case. So they subtracted $4,000 because this one has one extra bedroom. This one has one less bedroom. So they subtracted $4,000 from this one's price. But again, this is subjective. Everybody has a different value for every different characteristic. Some people want a bigger garage, other people want a smaller garage, and you can't really assign a dollar value to that. The next one is the cost approach. Replacement cost is the cost to replace a property with a similar one minus depreciation. So we have a little graphic here. Then the next one is the reproduction cost. Same thing. The cost to reproduce the same exact property minus depreciation. The next one is rent roll and income analysis. Net operating income, which is total income from the property minus operating taxes. We have that here. Next one is effective gross income. Gross income minus vacancies and credit losses. So it's basically what the owner of the property would earn if there were no vacancies. The next one is effective gross income, which is gross income minus vacancies and credit losses. This is just the amount of income that the property could earn minus the amount of income that it lost from vacancy and credit losses. So people defaulting, people not paying their rent. The next one is location and market conditions. You can see here price per square foot. Based on where the property is, based on other properties in the same area, you may divide the price of other properties by the square footage, and then you may multiply that price by the size of the property that you're looking at. So pretty simple here. Again, a lot of these are subjective because different properties will have different prices per square foot based on amenities, based on condition, based on finishes. All that stuff should be considered. The next one is market trends. So economic indicators, local real estate, market conditions, and neighborhood trends. We can see here tons of different locations where properties are being evaluated. The next one is property appreciation, which is historical changes in a property's value. You can use the Case-Shiller Home Index for this. This index is a way to see what a property should be worth based on its historical values. And the last one is occupancy rates, the percentage of a property that's currently leased or occupied. So, like I said, all of these metrics are purely based on the ability of a asset being able to generate cash flows, and all of these could change just based on market sentiment, demographics, interest rates. If population growth slows down or goes negative, the entire financial system could collapse. The entire legacy financial system relies on real estate and stocks because a lot of people borrow against their real estate to buy other things. Utility doesn't really matter. It's all about supply and demand. There are people who own tens, hundreds, or even thousands of homes, and they're not buying them for the utility. They're buying them because they know for a fact that real estate will always be kept artificially scarce. It'll always be kept scarce because the people in charge own real estate and they benefit from keeping it scarce. Real estate has become a business. People use it to generate cash flows like they would with a stock. They don't really care about the tenant. They don't care about who's living in it. All they're worried about is making more money. 10% of homes in the US are empty. This means 15 million homes are empty. If we keep adding more and more homes to the supply, it's not like it's going to make a difference because there's already more than enough homes that aren't occupied. A lot of homes are in maybe terrible condition. They haven't been kept up with. Maybe the maintenance hasn't been kept up with. Fewer and fewer people can afford to buy a home, meaning that demand is starting to drop and supply will eventually pile up. As prices stay where they are today, fewer and fewer people can afford those houses, and those prices aren't going to keep going up. Most real estate investors expect that they're going to see appreciation plus rental income. What happens if the demographics completely change and they don't see that appreciation? What I'm leading up to here is how to evaluate money. Money is different from all these other assets. A lot of people think that Bitcoin is useless because it doesn't generate any cash flows. And clearly, you can see here that all of these assets, we can see all these formulas, they're all based on the cash flows that are generated by these assets. Discounted cash flows, comparing metrics, which is price to earnings, of course, enterprise value, which is just the value of the company, divided by EBITDA, again, earnings. All of these are based on earnings, asset-based valuations, net asset value of the business. Of course, this would go up more if the company is generating more earnings. Okay, so let's switch over to Bitcoin. Let's switch over to how money should be evaluated. Money should be evaluated on its ability to fulfill the functions of money. Of course, you know what a store of value is. It's a way to store value for the future, to send value to your future self. A medium of exchange is a way to exchange value for value. So let's say you wanted to buy something. Let's say you wanted to buy a phone. You can give away money, you can get back that phone. That's what money is supposed to be evaluated based on. It shouldn't be evaluated based on its ability to make more money. You can't use the US dollar to generate cash flows. You can't use gold to generate cash flows. Bitcoin is the same thing. Bitcoin is money. It's not real estate. It's not land. It's not a business. It's not a building. Bitcoin is a form of money that can be used to fulfill all of these functions. The next function is as a unit of account. You want to be able to assign value to goods and services using the form of money that you have. If you can't assign values, if you can't price things in the form of money that you have, of course, it doesn't work. Right now, Bitcoin doesn't work fully as a medium of exchange and a unit of account because Bitcoin's price is very volatile. Collectively, as a society, we've all accepted that the US dollar is the best form of money that we have. So we value everything using US dollars. We value stocks and real estate on their ability to generate US dollars. In the case of money, we need to use these three functions to evaluate how money works. The next one that we should use to evaluate how money works, instead of using the ability to generate cash flow, we should look at the inflation rate. We should look at the rate at which a form of money is being produced. In terms of Bitcoin, I'm sure you've seen this Bitcoin supply schedule before. I've shown this to you multiple times. What this shows you is how much Bitcoin is being produced every 10 minutes. So for every single block, this is a Bitcoin supply schedule. It shows you the halving dates, when the epochs were. So every 10 minutes, a certain amount of Bitcoin is being produced. And every 4 years, this amount of Bitcoin is being decreased by 50%. So right now, the inflation rate of Bitcoin is lower than the inflation rate of gold. We can see here inflation rate. In this entire epoch, it would be 3.22%. That means about 0.8% per year. Right now, gold's inflation rate is about 1.5%. On the other hand, the US dollar's inflation rate is said to be around 7 to 10%. In order to see whether or not a form of money can fulfill these functions, you need to know the characteristics of money. These are the characteristics of money we can see here: fungible, portable, durable, divisible, scarce, decentralized, and saleable. So we can see here the main forms of money that we use today: the US dollar or fiat currencies, gold, and Bitcoin. Bitcoin does pretty well with every single one of these characteristics. The only thing that it doesn't have right now is a reliable track record. Bitcoin's only been around for 15 years, while gold has been around for 5,000 years. US dollar has been around for over 100 years. And of course, this makes a difference because people don't trust Bitcoin as much yet. And that's perfectly fine. Over time, I think they will. Over time, when they see that Bitcoin is around for 20 years, 30 years, 40 years, 50 years, they'll start seeing that this thing isn't going away. And maybe they'll move their wealth from US dollars and gold into Bitcoin. If we take a look at all the top assets by market cap, we can see here that gold is worth $17 trillion. And everything else is worth less, and it's not even close. Gold is a form of money. The reason why we want gold is because it doesn't change. We can use it to reliably store value for the long term. If you have an ounce of gold from 5,000 years ago versus an ounce of gold from today, they're the exact same thing. As long as they have the same purity, they would be the same atom, the same molecules. Everything would be exactly the same. An ounce of gold is equal to an ounce of gold. On the other hand, something like Apple, Microsoft, Nvidia, these companies have a lot of uncertainties behind them. The value of these companies is based on the guidance that the executives are giving to their shareholders. If the executives give a negative guidance, let's say they say that Apple is expecting less phones to be sold for the next quarter, the value of Apple is going to decrease significantly. It's going to drop off a cliff. On the other hand, with something like gold, there is no central party. There's no executive team. There's nobody telling you what's going to happen in the future. There's also no cash flows. Gold is purely based on its ability to store value and to be used as an industrial product. I think the industrial product part of things have a very small impact on the price, but gold is valuable, like I said, because of its ability to be used as money. Bitcoin has only been around for 15 years. It's already the 10th most valuable asset in the world. At one point, it was the 9th most valuable asset. But eventually, I think Bitcoin will become the most valuable asset in the world because of all the metrics that I was talking about. So we can see from these metrics that Bitcoin is the best form of money because it can fulfill all of these functions. Bitcoin has the lowest inflation rate compared to gold and US dollars. The US dollar's inflation rate, like I said, is 7 to 10%. Gold's inflation rate is 1 to 2%. Bitcoin's inflation rate is now 0.8%. And over time, it'll keep decreasing. more and more people are going to realize that Bitcoin's inflation rate is going lower and lower. The next characteristic that we should use to evaluate money is purchasing power parity, which is the price of a basket of goods in one currency versus another. What this shows you is whether or not your purchasing power is going up or it's going down. In terms of US dollars, everything gets more expensive over time. What this means is that your purchasing power is decreasing. It's going to keep decreasing forever because there's a small group of people that can produce more dollars and they can add it to the economy whenever they want to. The supply of US dollars is unlimited. The inflation rate can go up much higher than what it is today. As a lot of you may know, the US government borrowed and added 40% of the supply of US dollars into the economy in the 2 years from 2020 till 2021. And who knows what they'll do in 2025, 2026, 2027. They'll add more and more of these US dollars to the economy to keep asset prices up. As more US dollars are added to the economy, of course, all these assets can generate more cash flows. They can make more money, so people buy more of them. On this chart, we can see the price of a house in US dollars compared to the price of a house in Bitcoin. On September 1st, 2011, a house cost 26,399 Bitcoin or 217,000 US dollars. Today, the price of a house has doubled in terms of US dollars, but in terms of Bitcoin, it's dropped 99.9%. If you wanted to use the same amounts of money to buy a house today as you did in 2011, in terms of Bitcoin, you'd be able to buy thousands of homes, but in terms of dollars, you'd be able to buy half a home. We can also see the comparison with gold. You can see that in 2011, an ounce of gold cost 162 Bitcoin or $1,837. In terms of US dollars, the price of gold, this isn't accurate for some reason, but the price of gold is up to $2,500 now per ounce. But in terms of Bitcoin, it's down to 0.034 Bitcoin per ounce of gold. And this number is going to keep decreasing. In terms of US dollars, it's going to keep increasing because gold is more scarce than US dollars. And the final comparison here, of course, we have to look at how stocks have performed in terms of Bitcoin and in terms of US dollars. We can see here that in terms of US dollars, stocks just keep going straight up. They're just making new highs every few years. In 2011, one share of the S&P 500 cost $1,132. But in terms of Bitcoin, it cost 100 Bitcoin. Today, the S&P 500 has gone up about 5 times in terms of US dollars. But again, it's lost 99.9% in terms of Bitcoin. So when we evaluate Bitcoin, we shouldn't be looking at it as a business. We shouldn't be looking at its ability to generate cash flow. The most important things that we should be looking at are the scarcity and supply metrics that are applicable to any form of money. Bitcoin, of course, doesn't generate cash flow, but neither does gold. And we saw that gold is the most valuable asset in the world. Both Bitcoin and gold represent liquidity. If you ever need money, let's say you have some kind of financial situation that you've come across, maybe you have a margin call coming up, you can sell your Bitcoin or your gold for US dollars and you can pay for that margin call. Like I said, both represent liquidity, which is the ability to exchange an asset for cash. A lot of people think that Bitcoin is speculative, but at the same time, gold is also speculative. Everybody wants it because they believe it's scarce and they think that it'll remain scarce. It has industrial uses, but most people aren't using it for these industrial uses. They just have it in a safe somewhere. It's sitting there because people think that eventually it'll increase in value. They think it's scarce. They think more people will want it. On the other hand, Bitcoin is more scarce and this scarcity can be verified. Nobody knows exactly how much gold is in existence, but we know exactly how much Bitcoin is in existence. Most gold isn't being used for its industrial purposes. A lot of people assign value to gold because of the industrial purposes, but it's just kept in vaults for people to sell in case they need liquidity. Gold is valuable because people think other people will feel like it's valuable in the future. And I don't know how long this is going to last for. I'm pretty sure there will always be some value to gold because of its industrial uses, but I have a feeling that over time, it's going to drop significantly in terms of Bitcoin. We see that right now, 1 ounce of gold is worth 0.03 Bitcoin. In the future, it'll be worth 0.003 Bitcoin, then 0.0003 Bitcoin. It'll keep decreasing because the amount of Bitcoin is not going to increase past 21 million, but the amount of gold in existence will continue to increase. Newer generations aren't buying as much gold because they understand the value of digital scarcity. I think over time, as older generations pass away, the supply that's available, the supply that's being held in vaults right now, it's going to be passed on to these younger generations, and they're going to convert it into other assets. Some of this gold is going to be converted into stocks and real estate because, again, the younger generations, the people who are making these decisions, still see Bitcoin as something that doesn't generate cash flow, so it's speculative. But I think over time, the majority of it will flow into Bitcoin because Bitcoin is digital gold. It's gold, but it does so much more. The main difference between older generations and newer generations is that newer generations understand that digital goods can have value. They're used to playing video games. They're used to having computer files. They know for a fact that if their files were deleted, then of course they've lost a significant amount of the value that they've created for a very, very long time. Bitcoin is a way to store value on the internet, and I think a lot of younger generations will resonate with this. Bitcoin is better than gold, like I mentioned, because of the inflation rate being lower, but it's also better than gold because it's more portable. You can move it around much more easily. It's also more liquid. You can sell it around the world at any point. You don't even have to leave your house. You send your Bitcoin to an exchange, you sell it at the market rate, and you get back your US dollars. Right now, most people are attached to gold. If they like gold, they're attached to it because of its track record. They think it's had 5,000 years of history. It'll have another 5,000 years of history of being valuable with people. People will always find it valuable. But the thing is that if we increase the supply of gold significantly, let's say we find ways to mine more gold, it becomes easier to mine gold over time. We find gold under oceans. What's going to happen to the supply of gold? More and more gold will be added to the economy, and the people who are holding onto it right now are going to lose a significant amount of their wealth. Gold worked really well as money in the past because we didn't have any other self-sovereign money. Bitcoin is an invention of digital self-sovereign money. In a digital economy, gold doesn't work very well because you can't transfer gold to someone over the internet. You can't pay for goods and services and have them delivered to you. You also can't pay for digital goods across the world. Let's say somebody has an ebook that you want to buy. How are you going to pay them with physical gold? You have to rely on a central party to hold your gold for you and offer you tokens so you can exchange those tokens for these goods of value. On the other hand, Bitcoin can be directly moved from consumers to businesses across the world in minutes. Can you imagine how much value this will create for all of these other countries that aren't connected to the current financial system? I think it's going to change everything. Anyone can sell anything to anyone in the entire world. Anyone can create apps. They can get paid in Bitcoin. Anyone can create educational products and services. And over time, we know for a fact that one Bitcoin will always be equivalent to one Bitcoin. No matter how poor you are today, if you have access to Bitcoin, you can buy some. You can buy Satoshis. You can buy fractional units. Over time, no matter what happens, 20, 30, 50, 100 years from now, one Bitcoin will still be equivalent to one Bitcoin. If you have one Bitcoin today and you hold on to it, 50 years from now, one Bitcoin will still be equivalent to one Bitcoin on the Bitcoin network, regardless of sentiment. It doesn't matter what the price is. It doesn't matter what the US dollar value is. One Bitcoin is equivalent to one Bitcoin. So if you're a financial professional and you're advising people on buying or selling Bitcoin, not adding it to their portfolio or adding it to their portfolio, make the right decision. Make sure that you predict where Bitcoin is going based on the right metrics. Don't look at it based on the old metrics. Don't look at it based on stocks, the ability to generate cash flow, the ability to get tax benefits. You're not going to get tax benefits with Bitcoin because Bitcoin directly takes power away from governments and banks. So governments and banks aren't going to incentivize you to buy more. When you look at Bitcoin as an asset, look at it separately from everything else. Don't compare Bitcoin to US dollars. Don't compare Bitcoin to stocks. Don't compare Bitcoin to real estate. They're not the same thing. Every asset class has to be evaluated differently. Eventually, Bitcoin is going to $1 million or more. And like I said, most financial professionals aren't going to catch on until it's too late. And because of that, their clients are going to suffer. If you have a financial professional managing your portfolio, make sure that they understand what Bitcoin is. If you're a financial professional, make sure you understand what Bitcoin is and evaluate it using the right metrics because your clients are relying on it. If you're a client and you have a financial advisor who's not advising you on Bitcoin, maybe it's time to find a new financial advisor. If you want to learn more about Bitcoin, watch the video on your screen. And if you found value in this content, I'd appreciate it if you leave a thumbs up or a comment down below. Most people are going to ignore Bitcoin until it's $1 million or more because they think it's a Ponzi scheme. This video is part 4 of a 4-part series where I explain why I think most people are going to ignore Bitcoin until it reaches $1 million or more. In the first video, I explained why I think Bitcoin will go to $1 million in the first place. In the second video, I explained why the wealthy ignore Bitcoin today. In the third video, I explained why most financial professionals are ignoring Bitcoin and why they will continue to ignore Bitcoin. And in this fourth video here, in this fourth installment, I'm going to explain to you why Bitcoin is not a Ponzi scheme and why, if you're backing away from Bitcoin, if you're not putting money into Bitcoin, if you're not putting in the time to understand Bitcoin, if you're ignoring Bitcoin because it's a Ponzi scheme, then you need to watch this video all the way till the end, because I'm going to explain to you in depth why Bitcoin is not a Ponzi scheme and why the current financial system could be a Ponzi scheme. Let's get started. So just to start off, I came across a really great post on Reddit explaining why Bitcoin isn't a Ponzi scheme and why certain other businesses could be a Ponzi scheme. Keep in mind that Bitcoin is not a business. It's a commodity. It's something that you can own. You don't create profits out of it. Bitcoin is Bitcoin. So one Bitcoin is equivalent to one Bitcoin. There's no business plan here. There's no CEO. There's no company behind it. So you need to understand this as the basics of what I'm going to go into next. So this post on Reddit explained Bitcoin is not a Ponzi scheme. This is my short explanation to the people who are studying Bitcoin, looking to learn all about it and are smart enough to know about the existence of Ponzi schemes and has doubts if Bitcoin is actually one. To put it simply, a Ponzi scheme is a business model that could be incorporated in any business. Anything you sell could be a Ponzi scheme. Its fundamental mechanic is it promises its investors returns that are higher than what the business can actually generate with its working capital. In theory, if this business continues to run, it will completely deplete all of its cash and go bankrupt. The way a Ponzi scheme fills this gap and keeps the wheel turning is by always feeding the business with loans, not from banks, but from new investors. But since the business is already broken, it always needs more loans, and it grows exponentially until people realize what's happening, or simply that's as much interest it can generate. And the new loans will stop and the business will go bankrupt. People who lent money in the beginning make money. People who joined in the middle break even. People who joined last lose money. Bitcoin, on the other hand, is not a business, and it's operating with or without new people. So no matter what happens, Bitcoin will continue to operate. Your Bitcoin that you own will be yours no matter what happens to other people. So if other people think that this thing is now worthless and they don't want to own it anymore, you still own your Bitcoin. You're not relying on somebody else to fulfill an obligation to you. You still own that Bitcoin, because it's like having a gold bar, for example. Let's say you buy a gold bar from the bank and the bank goes bankrupt. You still have that gold bar if you took physical possession of it. Okay, so let's go back here. And it's operating with or without new people. Even if no one joins Bitcoin from today onward, the network will continue to operate. Bitcoiners will be able to transact normally. One BTC will remain one BTC. It doesn't need loans from new people, and it's not promising anyone returns. So returns for Bitcoin are not guaranteed. Nobody knows what's going to happen tomorrow. Nobody's going to know what's going to happen next year. Nobody knows what's going to happen 20 years from now. Historically, though, we've seen that because Bitcoin has a finite supply, the price keeps going up. And that's why I want you to look into it, because I think the price will continue to go up. Okay, the price has nothing to do with the network. Yeah, the network has nothing to do with the price. If the price drops, the network will continue to work. Bitcoin works if it was $1 exactly the same way as if it was $1 million. The price is not part of the network. The price is just how we value the Bitcoin network. And that's why Bitcoin is not a Ponzi. You might think it because someone convinced you that you will get rich from it, but that's not a promise that Bitcoin ever made. TLDR, Bitcoin is not a Ponzi because its operation is not dependent on new joiners nor the price. It will continue to run even if 0 new Bitcoiners join or if the price drops to $1 per Bitcoin. So from that post, you know that Bitcoin is not a Ponzi scheme and how Ponzi schemes work. Now I want to go a little bit deeper into the definition of a Ponzi scheme and explaining to you what a Ponzi scheme is exactly. So we're going to go to Investopedia. I love looking at this website because it shows you great definitions, pretty easy to understand. Ponzi scheme, definition, examples, and origins. What is a Ponzi scheme? A Ponzi scheme is an investment scam that pays early investors with money taken from later investors to create an illusion of big profits. A Ponzi scheme promises a high rate of return with little risk to the investor. It relies on word of mouth as new investors hear about the big returns earned by early investors. Inevitably, the scheme collapses when the flow of new money slows, making it impossible to keep up with payments of alleged profits. So with Bitcoin, there are no promised profits. Nobody's telling you that you're going to get a guaranteed profit. I think one thing that does guarantee profits is the US Treasury system, where you're getting a basically risk-free rate of return, and no matter what, you're going to get paid that amount. And based on the definition that person showed on Reddit, where they said new money has to continuously, we can see here, new money has to basically continue to be added to the market. The Treasury market works exactly this way. So if nobody buys US Treasuries anymore, the entire system collapses. The US Treasury market requires that people buy Treasuries so that the US government can keep borrowing more and more money and not have to pay insanely high interest rates. So the US Federal Reserve, which can print more money out of thin air, can start buying US Treasuries on the market so that the interest rate doesn't go up too much, so that the US government is constantly being able to add new money from new investors into its Ponzi scheme. So the game is rigged. It's not going to change. It's not going to break unless we leave the system, unless we start moving to another system that's not rigged. Okay, let's go back to Investopedia. A Ponzi scheme is similar to a pyramid scheme in that both use new investors' funds to pay earlier backers. A pyramid scheme usually relies on rewarding earlier participants to recruit more participants, but collapses when the supply of potential participants dwindles. So in this case, if new investors don't join this Ponzi scheme, whatever the Ponzi scheme is, the Ponzi scheme that they're explaining here, the pyramid scheme that they're showing here, if new investors don't join, the entire system falls apart because the people at the top are relying on new people coming in from the bottom and giving them money so they can continue operations. As soon as they stop getting money, as soon as they stop receiving money from the people at the bottom, the new people, the new entrants, the entire Ponzi scheme just collapses. And this isn't how Bitcoin works. This is not even close to how Bitcoin works. With Bitcoin, all you have is a network where you can confirm transactions. So if we take a look at this website, it's called mempool.space. On this side, we can see all the transactions that are not confirmed yet. And on this side, we can see all the transactions that are confirmed. So these blue blocks are the confirmed transactions. These gold blocks are the unconfirmed transactions. Keep in mind that these colors change over time as transaction fees go up and they come down. Right now, it seems like they are going up. Not too long ago, you could pay much less for a transaction. You could pay something like 20 cents, 25 cents to complete a transaction. But even today, I mean, it seems extremely cheap. $1.70 to get final settlement on one of the biggest assets, one of the most important assets in the world. It's essentially like being able to move a gold bar across the world for $1.70. In reality, moving a gold bar across the world will probably cost you hundreds of dollars or even thousands if it gets to that point, if you have enough gold. But what this network is, it's just a form of money. It's a ledger. It's a recording of all the transactions that have ever happened in the movement of Bitcoin, the token. So there's a token here. It's called Bitcoin. It's called BTC. Every time that Bitcoin is moved, every time those tokens are moved, the transactions are recorded on this ledger. This website is called mempool.space. This is a blockchain explorer. So if you go into this website and you open up one of these blocks, for example, let's say we go here, we can see the movement of Bitcoin between addresses. So let's say this person owns a Bitcoin. They move it to this address, this address, this address, and this address. What they're doing is they're spending their Bitcoin. So they're moving it from their one address to another. In this case, this person sent Bitcoin here, here, and here, and they sent the rest of it back to themselves. So we can see here that this address matches this address. We can see here that maybe they had this UTXO, this chunk of Bitcoin, and they wanted to send it to these people. And then the rest of it, of course, they had way too much Bitcoin. They only had to spend a certain amount. They sent the rest of it back to themselves. So what the Bitcoin network is all it is just the simple explanation of this is that it's just a network of computers that are recording the movement of Bitcoin. So Bitcoin can't be a Ponzi scheme. There's no business here. It's not creating a product. It's not creating a service. It's not offering you something some kind of returns. And nowhere on this website, this is the Bitcoin blockchain. Nowhere on this website is there a return, a promised return. The only reason why I think that the price is going to go up is because I think that demand for Bitcoin is going to go up. And I could be wrong on that. I could be completely wrong. I admit that I can be completely wrong on that. I don't think I'll be wrong, but I mean, you have to be realistic. You have to realize that sometimes there are things that you don't understand. The point that I'm trying to make here is that this thing is just a ledger, a copy. It's like basically like a notebook where you're just writing down what you owe and who owes you money. So if you owe money to someone else and someone else owes money to you, you're just writing it down on this record, on this notebook. Bitcoin is basically just the notebook, the ledger, the record. That's it. These computers are all sharing a copy of this network, of this ledger. So if we take a look at this website here, we can see here that this ledger, the entire record of transactions is 491.5 gigabytes. So you can basically use a home computer and you can download the entire blockchain. I'm not sure how big it gets. I haven't run a node personally. I do plan to do this in the future, but I'm not sure exactly if there's any nuances here that I'm not understanding. But essentially, my understanding here is that you can download 500 gigabytes of data and you can have a record of the Bitcoin blockchain. And you can have a full record like this, so you can go back to any transaction. Let's say you want to go to block 420,000. You can see what happened in this block, and you are keeping a copy of this recorded this set of transactions, whatever transactions are on this block. You're keeping a copy of all of these transactions in your computer. So let's say if you wanted to get paid in Bitcoin, you can go to your node, your computer, the computer that you're using to run the Bitcoin software and to keep a copy of this ledger, so this 500 gigs. You can go to that data that you have and you can confirm whether the person let's say if you are receiving Bitcoin, you can confirm whether the person who's sending you the Bitcoin actually has it. So let's say you can go into their wallet that they have, you can confirm how much Bitcoin that they have in that wallet, and you can see how many times the confirmations have happened, and you can confirm that this isn't a fraudulent transaction. So you're not receiving some kind of you're not receiving Bitcoin that can later be taken back. You're not receiving Bitcoin from someone who's manipulating the network somehow. So you can actually run a node of your own. You can make sure that you're not receiving paper Bitcoin. You're not receiving Bitcoin that doesn't actually exist. So back to the point of the video here, Bitcoin does not promise any returns. I don't know what the returns will be over the next year. I just personally think that the returns will be higher than every other investment. But you're not investing money in this case. You're just buying something. You're using it to save. It's like buying a bar of gold. If Bitcoin is a Ponzi scheme, then so is gold. It's like buying a bar of gold. So what you're doing is you're taking that bar into self-custody. You're owning it. You know what you have. And the market is willing to pay you for that bar of gold. The people who want to use that bar of gold, let's say they want to use it in electronics, let's say they want to use it as a savings vehicle, the market is willing to pay you for that bar of gold. The price of that bar of gold can decrease over time. It can decrease, it can increase. Anything can happen to the price of that bar of gold, but it doesn't mean that that bar of gold is a Ponzi scheme because it's a bearer asset. You're taking physical custody of that asset. Bitcoin is just a way to do the same thing that you can do with gold. Bitcoin is a bearer asset where you can take full self-custody. So with Bitcoin, you can do everything that you can do with gold. You can take full self-custody. You can put it in your own wallet, and you know for a fact what you have. You're not relying on somebody else to pay you in the future. This is why I'm thinking that the US Treasury market is a Ponzi scheme, because the US Treasury market is guaranteeing a return. They're saying that you get a risk-free rate of return, let's say 4, 5, 6, 7%, whatever it is. It could be lower, it could be higher, but they're guaranteeing a rate of return to you. How are they earning that rate of return? They're paying you back for that rate of return, that 4% rate of return, by printing more money, by borrowing more money. So essentially, they're exactly what the definition said on Reddit. They're borrowing money, they're creating new debt to pay back their old debt. This is a Ponzi scheme. This is the definition of a Ponzi scheme. The US Treasury market is a definition of a Ponzi scheme. Okay, let's go back to this. When the flow of new investments slows, the scam artist doesn't have enough money to pay out those supposed profits. That's when the Ponzi scheme collapses. So if people stop buying US Treasuries, what happens to that market? How does the US government pay its previous investors? Of course, it can create more money out of thin air. The US government is basically the world's only entity that can print US dollars. It can create US dollar denominated debts at will for however long it wants to, and the world is willing to accept those US dollar denominated debts as an investment. So what we have to think about here is how long will the world accept those US dollar denominated debts as an investment? How long will the world keep buying those US dollar denominated debts as an investment? So let's look at an example of a Ponzi scheme. Charles Ponzi's original scheme, conceived in 1919, focused on the US Postal Service and international mail. He received correspondence from someone in Spain who had prepaid international postage. This international postage reply coupon could be exchanged in the US for postage to send a reply back to Spain. This gave Ponzi an idea. There were tiny differences between the charges for the coupons and their redemption prices based on differences in currency exchange rates. Scaled up, this could return a profit. The concept was a form of arbitrage, which is not illegal. However, Ponzi was hardly engaging in this practice. It would eventually be discovered that he only had $61 worth of these postal coupons. He was collecting money from investors and paying out just enough to keep the scheme going. It lasted until August 1920, when the Boston Post began investigating Ponzi's Securities Exchange Company and its promise of a 50% return in 90 days and later just 45 days. Ponzi was arrested by federal authorities on August 12, 1920, and charged with several counts of mail fraud. So with Bitcoin, the only way to actually create a Ponzi scheme is to create paper Bitcoin. So let's say if you were to go on this mempool website here, if you were to have a transaction completed on this mempool website, you know for a fact that you're receiving real Bitcoin. If you run your own node, you can confirm that you're receiving real Bitcoin. So let's say if we look at this, let's go further back. Actually, we'll go a little further back. So if we go to this block here, if we go to this transaction right here, we go to this transaction ID, we can see here that this Bitcoin, 71 Bitcoin, that's a big transaction. So this Bitcoin was moved from these addresses over to these addresses. So now we know for a fact that whoever owns this address received all of this Bitcoin, and they can confirm that they have real Bitcoin because they can confirm it on their node, they can confirm it on mempool, they can confirm it on their wallet. They know for a fact that they have real Bitcoin. So this transaction was for, let's see here, $5.4 million. This transaction, because it was confirmed on mempool, because it was confirmed on the nodes, it means that this transaction happened. And now whoever received this transaction, whoever controls the keys to this address, can now move this Bitcoin wherever they want to. They can spend this Bitcoin, they can send it somewhere else if they want to, they can do whatever they want with it. So because Bitcoin doesn't have counterparty risk, because with Bitcoin you're not relying on somebody else to pay you back, Bitcoin on the layer 1 can't be a Ponzi scheme. It's not possible for it to be a Ponzi scheme because you're not relying on somebody else to take custody of your Bitcoin. You're not relying on somebody else to pay you back at some point in the future. When I was referring to paper Bitcoin, I was referring to something like, let's say Coinbase. If you deposit your Bitcoin at Coinbase and you just let them hold it, what they can do is they can run a fractional reserve banking system. This is exactly what FTX did. This is why FTX collapsed. So let's say you deposit your Bitcoin at Coinbase. Coinbase takes custody of your Bitcoin. They have full control of it, and now they can do whatever they want with it. They can write in their database that they owe you a certain amount of Bitcoin, and they can show you a wallet. They can say, in this wallet, there's this much Bitcoin. But unless you can see that transaction on the mempool, unless you can confirm how much Bitcoin Coinbase has on the mempool, you have no idea whether your Bitcoin is actually there. What I mean by paper Bitcoin is that it's an IOU. So if you have your Bitcoin on Coinbase, Coinbase can do whatever they want with your Bitcoin. They can take that Bitcoin, they can lend it to someone, they can sell it, and they can expect the price to come back down. And then when it comes back down, they can buy it back. They can do whatever they want with it. That's up to them. It's their choice. It's their decision. What Coinbase can also do is they can keep a small stash of Bitcoin that's available at any time for withdrawals. So let's say a lot of customers start withdrawing. They just start withdrawing. They start withdrawing. Coinbase knows how many people will probably withdraw at most. Let's say they keep 40% of the Bitcoin. I'm assuming that 40% of Coinbase's customers won't withdraw at the same time. But if they do, and Coinbase doesn't have, let's say 50% of customers withdraw, and they don't have 50% of the Bitcoin that they own, they've lent out 90% of their Bitcoin, they only own 10%, they're going to go bankrupt, just like FTX. So what happened to FTX was FTX held only a small amount of Bitcoin. They had lent the rest of their customer Bitcoin to Alameda Trust, Alameda Research. I think that's what it's called, Alameda Research. So they had lent this Bitcoin to Alameda, and Alameda had used it to buy altcoins or to invest in different things. FTX actually used some of that Bitcoin to the CEOs, the executives used some of it to enrich themselves. So they used it to buy houses, to buy condos, to buy nice cars. And that's what a Ponzi scheme is. A Ponzi scheme is where they tell you that they owe you something, they can pay you back later, and they'll give you interest. Let's say this is what happened with BlockFi, this is what happened with Celsius. Celsius and BlockFi were paying people interest. So the people who had their Bitcoin stored on Celsius and BlockFi were receiving an interest payment every month, every day, however it was calculated. They were receiving this interest payment, and eventually when customers wanted to withdraw their Bitcoin, they couldn't withdraw it, and BlockFi and Celsius eventually went bankrupt. I don't know the exact details for those two, but I think that's about it. I think that kind of summarizes it. Something really important to understand here is that once trust goes away from a Ponzi scheme, let's say with the US Treasuries market, once that trust fades, it's never going to come back, and that Ponzi scheme is not going to survive. It's very likely going to go bankrupt. Whoever's running the Ponzi scheme is very likely to go bankrupt. So based on this, because Bitcoin isn't a Ponzi scheme, because of the nature of the asset, the fact that it's a bearer asset, you can take full self-custody of it. What I believe is that in the medium term, let's say in 5 years, Bitcoin's price is going to hit $1 million. And by then, most people will not have adopted a Bitcoin standard. Most people will not own Bitcoin. I genuinely think that it's possible that Bitcoin could hit that $1 million by the end of this cycle, by the end of 2025. I actually think that's possible because ETFs have completely changed the game. ETFs have given retail market participants the access to Bitcoin that they've never had before. So these retail investors can buy as much Bitcoin as they want to because now they have full access in their trading accounts. So their trading accounts with their 401ks and their RRSPs, their TFSAs, their Roth IRAs, all of this money can now go into Bitcoin. So what's going to happen here is the early adopters, the people who are early to this thing, they're going to buy as much as they can, because I know for a fact that if you understand Bitcoin, if you figure out how Bitcoin works, there's no way that you're not going to want more. So the early adopters are going to keep buying, and we're going to see that the late adopters, the late people are probably not going to get in until a few $1 million. I would say at least 90% of people will ignore Bitcoin until it reaches $1 million. And that's because this thing can go to $1 million really, really quickly. I know a lot of people are going to sell as Bitcoin's price goes up, but the buying pressure and the demand is going to be relentless. I think we could regularly start seeing Bitcoin rising by 50 to 75% in a very short time frame, and then dropping another 20 to 30% to correct a little bit, to get all the weak hands out of the market, and then it starts proceeding back up. I think that's going to happen. I think because of the ETFs, we're probably not going to see the same deep bear markets that we saw before, because ETF investors can buy as much Bitcoin as they want to. In the last few days, the Securities Exchange Commission also confirmed that we're going to see options trading on the Bitcoin ETFs in the coming weeks and months. So all of this is just coming together, and it could bring in this wave of liquidity that makes it so that most retail investors get priced out of owning 1 Bitcoin, 0.1 Bitcoin, 0.01 Bitcoin by even a few years from now. 94% of Bitcoin has already been mined and it's owned by someone. People have to own Bitcoin. It's a bearer asset. It can't just be sitting in cyberspace. Someone has to own it. Someone has to own the ability to move it around. So 94% of it is already owned by people. Over the next 120 years, we're going to see another 6% of it being added to the economy. So this seems almost like a once in a lifetime opportunity. And I think a lot of people are starting to catch on. They're starting to figure out where this is going. So as they figure it out, they're going to start accumulating more and more. They're going to start buying Bitcoin with the intention of literally never selling again. I think the people buying the ETFs are very long-term investors. They're not going to sell for 5, 10, 15 years because these people have been in the markets for a long time already. They understand the value of buying and holding. They understand the value of time in the market versus timing the market. They understand that if they just hold on, they'll very likely do extremely well with Bitcoin. So as the available supply of Bitcoin decreases, as this bearer asset gets more and more scarce, more and more rare to find on the market, the price will have to go up to bring sellers to the market, to get people to sell their Bitcoin. So let's say when Bitcoin's price goes to $100,000, a lot of new sellers are probably going to go back to the market and sell what they have. But eventually these sellers will run out because Bitcoin is a finite asset. The only people who can sell it are the ones who own it. So after we go into another period of consolidation, maybe, so right now we're in a period of consolidation. I've made a couple of videos on this. Bitcoin's price has been moving sideways at $60,000 for almost 8 months now. Maybe when we go to $100,000, Bitcoin's price starts moving sideways. Maybe it goes from 100,000 to 80,000, 100,000, 80,000, 100,000, 80,000. And then once the sellers run out, it starts pumping up again. It goes to 150,000. Then it goes to 200,000. Then it goes to 300,000. Who's going to stop this from happening? Nobody can stop this from happening. Unless you have Bitcoin, then you can possibly stop it from happening. Maybe you can slow it down. But eventually, you run out of Bitcoin. If you're selling Bitcoin, you run out. If you use the futures market and Bitcoin starts popping, Bitcoin's price starts just skyrocketing overnight, you could lose all of the money that you have. You could lose every single dollar of wealth that you've generated your entire life, and you could go into a negative position by gambling on keeping Bitcoin's price down. So I don't think a lot of investors are going to do this for a very long time. And if they do try to do this, if they try to suppress the price of Bitcoin, because it's a bearer asset, like I said, the price is going to eventually skyrocket. It's eventually going to start increasing, and the people who are trying to short Bitcoin, trying to manipulate the price down, are going to fall apart. They're going to lose a significant amount of their wealth. I hope this video gave you an explanation of why Bitcoin is not a Ponzi scheme, why I think that most people will continue to ignore Bitcoin until it's $1 million or more. Bitcoin is just a form of money. It's a commodity that can be moved from one person to another. You can use it as money. You can use it to transfer value from one location to another, from one address to another, from one person to another, and anyone can take full self-custody of this, making it completely different from the current financial system. And now I want you to watch my video on why I think the current financial system is a Ponzi scheme.